Listen, financial freedom in today's economy, it is absolutely not a privilege reserved just for those with inherited capital. It is a calculated science. Welcome to this explainer. If you've ever felt like the whole system is just rigged against you, prepare to completely shift your perspective. Today, we're going to decode the exact blueprint you need to build a financial empire from absolute scratch.
It's a stressful, terrifying reality for so many people right now. So, what if you're starting from the absolute bottom? You're living paycheck to paycheck, you've got zero savings, you have zero investments, you're pulling in an average or maybe even a below average income. Is wealth still actually possible for you, or is it just a total fantasy?
The answer? Absolutely yes. Literally millions of self-made millionaires, people who didn't inherit a single dime, started with exactly this number, zero. The difference between staying at zero and building massive wealth isn't some miraculous lucky break or a lottery ticket. It is a calculated, systematic process, and we are going to break that process down into 6 distinct phases.
Our journey begins right here. Phase 1, master your money.
Look, before you can even start thinking about compounding interest, you need absolute financial hygiene. If you can't manage $1,000, you will never be able to manage $1 million. This means tracking your income and expenses digitally, ruthlessly cutting out whatever doesn't serve your goals, and knowing exactly where every single dollar is going. And that all starts with the ultimate scoreboard of wealth, your net worth. It is simply the value of your assets minus your liabilities. That's the whole equation. It's not about how much money you make, it is about how much money you keep. Think about it. If you earn $200,000 a year but you spend $210,000 on fancy cars and vacations, your net worth is dropping. You're actually moving backward. Now, to master your money without feeling completely suffocated, you need a strict, actionable framework. Financial experts often rely on the 50-30-20 rule. It's a brilliant way to manage an average income and start forcing your money to work for you, rather than just watching it slip through your fingers. Under this framework, every single paycheck is aggressively divided up. 50% of your income goes to your absolute needs. We're talking housing, groceries, utilities, basic healthcare. 30% goes to your wants, dining out, keeping those endless streaming subscriptions, having some fun. But here is the absolute game changer. That final 20% must immediately go toward your future. That means savings, investments, and aggressive debt reduction. That 20%, that is your wealth building engine. Okay, once your money is organized, we shift right into a defensive strategy. Phase 2, build an emergency fund. Because, let's face it, life happens. Cars break down, water heaters burst, medical emergencies pop up. These things are a mathematical certainty. To avoid falling into toxic debt, your immediate, non-negotiable starter goal is exactly $1,000. That is often just enough to cover a sudden repair bill without having to swipe a massive high-interest credit card. But that $1,000, that's just your starter shield. Your ultimate safety net target needs to be a fully funded emergency reserve that covers 3 to 6 months of necessary living expenses. If you lose your job tomorrow, this fund guarantees you can keep a roof over your head and food on the table while you figure things out. Now, this money is not for stock market investments, and it is definitely not for a vacation. It has to remain in a highly liquid account, specifically a high-yield savings account, so it's actually earning some interest and fighting off inflation while it sits there waiting for a rainy day.
So, how do we actually get there? Here are the exact mechanics. First, you set your specific target number. Second, you keep it liquid. And third, this is absolutely crucial, automate your savings. Sticking to a plan relies entirely on removing human error from the equation. Set up an automatic transfer from your checking account straight to your emergency fund the very day you get paid. Just put it on autopilot and let the system build that financial fortress for you.
All right, with your defensive shield securely in place, we have to confront the silent destroyer of wealth. Phase 3, eliminate bad debt.
High-interest consumer debt, like those lingering credit card balances, mathematically guarantees that you will stay poor. Attacking it is essentially the best guaranteed return on investment you can possibly make. You've got 2 primary weapons to use here. The snowball method means you pay the minimums on everything, but you aggressively attack your smallest debt balance first. Once it's gone, you roll that payment into the next smallest. It builds massive emotional momentum. On the flip side, you can use the avalanche method. This targets the debt with the highest interest rate first, regardless of its size. Mathematically, this saves you the most money over time. You just need to choose the psychological or mathematical path that works best for your personality, and then attack that debt relentlessly. Now we pivot from playing defense to playing offense. Phase 4, increase your income. The reality is, you can only cut your expenses down so much, but your earning potential, that is theoretically limitless. Relying on just a single paycheck is incredibly dangerous these days. You really must leverage digital, highly scalable side hustles that require practically zero startup capital. Things like virtual assistants, affiliate marketing, freelance transcription, social media management, or user testing. In today's digital landscape, your skills are your capital. The real goal here is to build up multiple income streams that run on systems, rather than just trading your precious time for an hourly wage. And that brings us to the most exciting part of the entire journey. Phase 5, start investing wisely. This is the exact moment your cash transitions into real assets, working tirelessly for you while you sleep. But before we even look at building portfolios, you need to understand this amazing insider mathematical shortcut that financial mentors use all the time, the rule of 72. It's an incredibly simple way to visualize the pure magic of compound interest. You just divide the number 72 by your expected annual rate of return. The result is exactly how many years it's going to take for your money to double. So let's say you invest in a broad S&P 500 index fund, averaging a 10% annual return. You just divide 72 by 10. That's 7.2. That means every 7.2 years, your wealth completely doubles, entirely passively. It is absolutely mind-blowing when you truly grasp the math behind it. And this perfectly proves why time in the market is vastly more important than trying to perfectly time the market.
Just watch what happens over 2 decades. In the first 5 years, sure, the growth curve is pretty modest. By year 10, you can really see the momentum building. But by year 20, compound interest completely takes over and your portfolio value just explodes upward. Your earnings literally begin earning their own earnings. Guys, this is exactly how ordinary people build extraordinary, multi-generational wealth. Finally, we enter the last phase of the journey. Phase 6, protect and grow wealth. Because creating an empire is really only half the battle, right? Preserving that financial fortress you've so carefully constructed is what actually keeps you wealthy. The core of this protection strategy is asset allocation and diversification. Basically, you're spreading your money across different asset classes, like stocks, bonds, and cash reserves. Now, this mix is entirely personal, based on your specific time horizon and your own risk tolerance. When the market gets volatile, a diversified portfolio acts like a giant shock absorber. And periodically, you just rebalance that portfolio to make sure it stays perfectly aligned with your goals.
But protecting your wealth goes way beyond just the stock market. You have to secure adequate health and life insurance to prevent any catastrophic financial wipeouts. You absolutely need basic legal planning, like wills and trusts, even if you feel your wealth is pretty modest right now. And crucially, continuous learning. Economic trends shift so rapidly, staying informed is what ensures you are always one step ahead of the curve. To truly wrap our heads around the power of these phases, let's look at 2 vastly different paths. Person A spends every single dollar they earn, relies heavily on high-interest credit, never invests a dime, and completely ignores financial literacy. Then we have Person B. They adopt the exact strategy we just outlined. They save their 20%, eliminate bad debt, invest consistently, and build up multiple income streams. Over a 20-year timeline, the gap between these 2 individuals isn't just a few $1,000s. They are living in entirely different stratospheres. One is trapped in constant anxiety, and the other has purchased total, absolute freedom.
So here is the bottom line. You do not need to be born rich to become wealthy. You don't need a perfect salary, and you definitely don't need a lucky break. What you need is unshakable discipline and relentless consistency. As the old saying goes, an investment in knowledge always pays the best interest. The entire blueprint is now in your hands through this explainer. But here is the ultimate question you have to answer right now. 5 years from today, will you be celebrating the financial empire you started building today, or will you still be waiting